It's September 2007, and the Federal Reserve has decided to cut interest rates by 50 basis points. After a full 12 months of keeping their interest rate hovering at around 5%, the Fed decides to begin cutting interest rates in response to increasing economic weakness. Federal Reserve officials were of course quick to reassure the public regarding the economic outlook, with the Dallas Fed saying that the economy was on track for a soft landing, and Alan Greenspan, the former Fed chairman, saying that the US was not heading for a recession. In fact, the US stock market following this September interest rate cut actually surged to new all-time highs, breaking above the high that it made a few months earlier in July. If this story sounds a bit familiar, that's because it is. Fast forward to today, and the stock market has made a new all-time high in the month of September, breaking above the peak it made in July. Optimism that comes following the Federal Reserve's decision to cut interest rates by 50 basis points in their September meeting. This decision ends the Federal Reserve's year-long pause at a 5% interest rate, the highest interest rate since 2007. And again, Fed officials are quick to reassure the public regarding the economic outlook, with Jerome Powell himself, the head of the Federal Reserve, saying that he sees no recession risk today. Now, in hindsight, we know that the optimism around this first rate cut in September of 2007 was quickly faded as the United States did go into a recession, and as the unemployment rate did continue to climb higher over the next 2 years, peaking at an impressive 10% and completely breaking the financial system along the way. The question is, how similar are things today? Now, aside from the fact that the Federal Reserve decided to cut interest rates in September by 50 basis points in both cases, the most obvious similarity is that in both 2024 and 2007, we have a rising unemployment rate. Now, this is important because unemployment tends to rise and fall with a kind of momentum. When unemployment begins to rise from low levels, that tends to suggest that you're heading towards a larger upswing in unemployment, which tends to go hand in hand with economic downturns. And as we know from history, economic downturns don't tend to be the greatest thing for US stocks. Now, there has been a few instances in history where the unemployment rate rises briefly but ends up coming back down and never playing out for a recession. Now, something similar could end up playing out today, which would put us in a substantially different position to 2007. But that brings us to our second big similarity that we have between 2024 and 2007. Something called the Index of Leading Economic Indicators is flashing an economic warning signal today. This is an index that was composed by an organization called the Conference Board, and it's made up of things like building permits, consumer expectations, the yield curve, a leading credit index, and a bunch of other metrics. These are all things that are meant to predict future economic growth. Even the S&P 500 index is in this composite because the stock market is meant to be predicting future economic growth. Now, while some of these indicators are pointing up right now, like the stock market, most of them are pointing down. And we look at the data for it going back to the 1960s, this is what it looks like. And there is a pretty clear pattern. When this index is coming out of a trough, that typically means the economy is coming out of a recession and experiencing a recovery. As long as the index is pointing upwards, the economy is in a period of expansion. When the index is rolling over and pointing down, you're typically in the peaking process before an economic downturn occurs. And that's what you call the business cycle. This is what the usual sketch is. There's a trough, followed by a recovery, followed by an expansion, followed by a peak, and then a recession, and then the process starts all over again. And today, according to leading economic indicators, we are in the peaking process before a recession. The only problem with that is the fact that we've been in this phase for the last 24 months. Leading economic indicators have been pointing consistently downwards for the last 2 years. Now, we did kind of have something similar back in 2007. The peaking process began in early 2006. The recession didn't begin until January of 2008. So while this index does give a great indication regarding where we are in the economic cycle, it doesn't really help us to understand whether this breakout to new all-time highs that we have in September of 2024 is going to end up playing out like the breakout that occurred in September of 2007, which we can say it didn't end well. Now that brings us to the differences that exist between today and 2007. And we have to start with the price of oil. This is a chart of oil prices going back to the early 2000s. This is September of 2007, and this is September of 2024. It doesn't take a genius to see the difference here. Back then, oil prices were climbing to new all-time highs very quickly. One could definitely argue that oil prices were on a spectacular melt up here, and these rising oil prices were instrumental at accelerating the economic slowdown in 2007. Today, oil prices have been steadily declining and actually making new yearly lows in 2024. Now, yes, this decline reflects the fact that global energy demand is going down, which indicates that the global economy isn't exactly thriving right now, but this also means that there isn't a big supply shortage of oil that's pushing prices higher, which throughout history has been one of the primary causes behind economic recessions in the United States. Now, that brings us to our second key difference between today and 2007, and it's something called the internal strength of the stock market. When a significant breakout occurs on an index like the S&P 500, we want to make sure that there is a lot of internal strength. That means that a large number of stocks within the index are moving higher to support that breakout. If only a few stocks are participating in a breakout, it's more likely to fail. In order to get a sense for the internal market strength, we can look at an indicator called the advanced decline line. It shows us how many stocks are moving up or down within the entire New York Stock Exchange, giving us an idea of what the internal strength of the market is. And this is what it looked like in September of 2007. The advanced decline line was showing that less stocks were actually moving higher than in July of 2007, despite the S&P 500 index attempting to break out to new all-time highs. This showed a lack of internal market strength in September 2007. Fast forward to today's breakout and we see a completely different picture. A large number of stocks are participating in this rally. This is what you can categorize as internal market strength. So this builds a solid case for why this breakout to new all-time highs could actually hold today, despite the many concerning similarities with the 2007 false breakout. We remain convinced that the economy is in the process of peaking and heading towards a recession. But the data that we're looking at is not pointing to the same thing for the stock market right now. We've been calling for stocks to move higher over the last year, and we've helped our clients make an incredible number of successful trades this year. We send out buy and sell alerts on individual stocks, ETFs, crypto, and commodities. So far this year, we've been able to make some big winners while keeping our losses very limited. That is the key to becoming profitable in markets. I teach you everything I know about financial markets and trading